Hello, this is the fourth video of the Ontology of Money series, and at this point it should be already quite clear that money is a promise to pay. It is a promissory obligation. It can be in the form of a promissory note if it is in a more simple system. It can be in a digitized format, such as we have in some way in the current banking system. Well, but as we explained in the previous video, or as I tried to explain in the previous video, our promises to pay, they are somehow, we call it obfuscated. So it occurs an obfuscation. Well, this term in general, when people hear it the first time, they go, "Oh wow, I don't understand what obfuscation means." Well, I can say my native language, Portuguese. In Portuguese, for instance, this term, which differs a little bit from what you have in English, it means, for example, when we look at the sun, if I look at the sun now, for instance, and stare at the sun, my vision becomes somehow blurred. So the sun obfuscates my vision. My vision becomes obfuscated because I cannot see clearly what's in front of me. I cannot see the details because the sun then makes such an impact on my retina with its light that it obfuscates the rest. When I try to look somewhere else, it's obfuscated. Well, then you can think about our promises to pay being obfuscated in such terms, even though in the English language the term obfuscation has some different meaning, and you can look for yourself. It's even used in programming. Well, it can mean also when someone tries to hide something behind an appearance of something. Well, our promises to pay are there at money creation. When we purportedly borrow money, we are signing promises to pay. And as we demonstrated even in central banking manuals, it's admitted that money is created at that moment when we sign our promises to pay. Who are we promising to pay? Now I'm going to expand a little bit upon what we already introduced in the previous videos, right? In this regard. So in this equation, if we can say so, if we can call it so, we have on one hand the promisor, who needs the medium of indirect exchange, and someone who gives up the property. So you need the medium of indirect exchange to indirectly exchange your own production with the person who is, or the party which is giving up that property that you want to take possession. Sorry for it slipped here, the telephone. Well, so you then you want to take possession of that party's property. That person or party then will get that those tokens and give up that property in an equivalent basis. That person expects that, let's say, giving up a house, his house, that he worked for to get ownership of that house. So that person expects that the money, the medium of indirect exchange, is equivalent, will give that person the right to take from the economy or the overall pool of wealth equal measures that that person is giving up. And on the other hand, the promisor then, what is this person promising? He's not promising to pay money to that person, because the medium is then already given to that person, who is already in possession of the medium. So the person then is promising to produce goods or services and make them available on the market, on the economy, so that others will then acquire, buy those goods or services, and then making the already circulating medium of exchange, currency, to flow into the hands of that promisor, back to that promisor. If there is no, let's say there is no money in circulation, zero, and through the promise to pay, the promisor creates, say, 100,000 units, promising to produce 100,000 units worth of goods or services. Then that amount goes to the former owner of the house, who gives up the house and transfers the ownership of the house to the promisor. Now, what do we have? We have 100,000 units in circulation, because that former owner of the house, who now is entitled to that sum, to that value, will go to the market and start to circulate that money further. And then by circulating, it circles back to the promisor, because we can and should only we should only allow the creation of such money if that promisor indeed is capable of contributing to society in a way that by contributing to society with goods and services that are needed or desired, because then we can certify that. And I'm saying in general, okay, then it becomes clear that that promisor will redeem the promise, and the cycle of indirect exchange will be fulfilled. Well, but as we have another party involved in this operation, which takes possession of all these tokens that are generated in these indirect exchange, as the money is created, it falls into the hands of the centralized system. They then claim that that money belonged to them, that they are the prior owners of that money that didn't exist before the signature of the promissory obligation. And they charge, on top of the principal, which is that sum, 100,000, interest. Or we should call it usury. Going back to the previous video in which we started to discuss the idea of usury. Usury has been modified in the definition of usury has been recently modified quite conveniently. It used to be the simple charge of interest of any kind, any sum above principal. It was called usury. It started to become excessive interest. Who is to define what is excessive? Themselves. Well, whoever, right? There is no proof about what is excessive or not. In fact, any sum above principal that is charged to the promisor is excessive, is abusive. Why? Because there is no lending taking place. The promisor is not borrowing money, is issuing money. The issuance of money only occurs when the promisor engages in this indirect exchange through the promise to pay. So there's the obfuscation when we say that this fact is not present in any of the contracts. There is no clear definition of the promise in the promissory note that money didn't exist before the person or the party, the promisor, signed the promise to pay. What on the contrary, what is pushed down the promisor and society's throat is that they are borrowing money, and therefore they should pay interest because, well, you're borrowing something from someone and they have some interest, right? And why would they lend money? By the way, this is the claim of many of those self-proclaimed economists and the Austrian economists. They say, well, who would lend money if we could not charge interest, right? Well, as they are always looking for investments and things like that, how to make their money work for them, quote unquote. Well, sorry for the sarcasm, okay, but yeah, they will think that way, of course. But we who want to work and not make others or something work for us, who want to contribute with our labor and production, our creativity, our energy, our time, our efforts to give to society and make our creativity, our spirit manifest in some form of product so that others can then benefit from it. We know that, well, if we could just promise our production and pay without ropes around our necks to suffocate us with usury, if we could live in a world without interest, we would, because that's sanity. It's insanity to charge interest on a fake loan. Who in their right mind would choose to pay interest on a fake loan or even in a real loan if they have the power to create money through promises to pay? Mr. Austrian, sorry, wake up. Sorry for the sarcasm, but yeah, these people come with, some butterfly butterfly ties and comment, yo, who would borrow money? Who would lend money if the interest was not charged? Sorry, money is a promise to pay. I'm sorry, Mr. Austrian economist, so-called. We are the creators of money. Can you fathom that? You, Mr. Austrian, whoever who is out there listening to this, can you fathom this? Sorry for shouting, but I can do this because I'm inside a car and people will not think I'm crazy. Can you fathom this? We had the power in our hands. And this power is being obfuscated from us for millennia. Do you understand this? Do you understand the magnitude of having the power to issue money? Wake up! Let the coin drop. You create money. It's that's, we live in an insane world, and we have all these top executives running around with their fancy suits, pretending that they are lending anything. I will put under the description, I don't know from the top of my head, but I found a quote from one of the founders of the Federal Reserve, the president of the CITYBANK, right? Mr. VANDERLIP. I think that's his name, found some years ago in a publication by bankers. He wrote in an article admitting it. It goes along these lines, okay? You can read in the description the correct quote. But it says, it's a big misconception to believe that money is first, that money exists before being lent, because the business of a bank is to exchange credits. Well, I will put the quote because it's quite, it's something that we have, we from mathematically perfected economy who support the thesis of mathematically perfected economy, we have been saying this for ages. Mike Montaigne, who is the founder of mathematically perfected economy, the architects of mathematically perfected economy, who devised the thesis and the theorem, he has been saying these things. We have from the horse's mouth, and you can read in the description, the admission. But well, let me try to then recenter here the discussion. Why on earth then would someone who has the power to issue money borrow money? I think that's clear already, right? I believe. Let's talk about mathematically perfected economy then. This is going to be a longer video. Well, mathematically perfected economy is the thesis, was first devised in 1968 by Mr. Mike Montaigne, who he was 16 years old, and he was undergoing some program in his school, which got kids who excelled in math and other disciplines to attend lessons of college grade lessons, and one of these classes was about economy. So they were teaching the introduction to economics, and he was not really interested, by what I remember. When I spoke to him and by listening to his podcast, he was not interested in that. And when he received the book, the economics book, he just started to look at the book, page after page, and he noticed there was no theorem. And he was already used to produce theorems. And he used to say that he was even able to produce the proof to the Pythagorean theorem from the top of his head. And that he excelled in math, that he was studying ballistics and so on. So he had quite advanced knowledge, math knowledge, to his age. And then there were two lessons in which he could see a contradiction in the formal economics theory. So first they explained that yes, money was issued and created through when it was called for in loans. So when there was a loan taking place in production with a collateral, right? That money would be created. So there would be, let's say, 100,000 worth of property, and then 100,000 would be created. So that there we can see that there is a 1-to-1 ratio of money that is issued and enters into circulation equivalent to the value of the property. This was the first observation in that book or in a specific lesson. And on top of that, it was said that interest was charged on top of that principle, right? On top of the 100,000, let's say. So there would be more debt. The amount owed in this circumstance would be higher than the value of property. So there is already an imbalance in regards to in this equation here. That is just a fact. The fact number one, right? Always interest is charged when property is represented by new money through loans, so-called. Second lesson. His teacher then says, every time money is created, we suffer inflation. And then Mike already thought, well, what is he saying? What is inflation? And then the definition of inflation and deflation, respectively, is increases or decreases in circulation in relation to the value of the properties that money represent. So let's put it in other terms. The definition in Webster's dictionary at his time, 1968, was it was an excess of money in circulation in relation to the value of the goods. Let's say that the goods that are represented by that money, new money. Again, so if 100,000 enters into circulation to represent 100,000 of property, there is an equivalence, right? It's the same. Let's say enters 100,050 or 200,000 is created and enters into circulation somehow when 100,000 only when we only have 100,000 in terms of property. So then there would be an excess of money in circulation, right? Then there would be inflation, more money in circulation in relation to the value of the property. But that's not what happens. Why? Because at most, maximum, only 100,000 can be issued to represent 100,000 units of worth of something. A house, for example. It's not 200,000 is not issued to represent 100,000 dollars, let's say, a home. Only at most 100,000. So it's not possible that there would be more money into circulation, at least in this initial stage, of course, in relation to the value of the value of properties. And on top of that, we have interest. Down the road, more money must be owed, and must leave circulation than there is in circulation. So if 150,000 needs to leave circulation from that operation, there is a deficit in the quantity in circulation in relation to the value of properties represented by that money in circulation. More money is owed than there is in circulation. So what we have instead is deflation. It's a deflationary process. There's less money in circulation in relation to the value of property. Well, he explained that to the teacher. Of course, you should listen to Mike Montaigne explaining this, because no other can explain as perfect as him, in a more accurate and precise manner than him, because he's a mathematician, right? Self-taught, but I would say even a genius. So you should listen to the guy. I'm only doing this because most of you did not listen to him. I wish I wasn't doing this. But then the whole book is invalidated. The whole theory of economics is invalidated. Because it's a contradiction. And then he was at that time 16 years old. He just raised that contradiction. He got his teacher agreeing with him that was an impossibility, a mathematical impossibility, and that the claim was incorrect. And he moved on with his life. And when he thought that other minds had already figured it out, like noticed these contradictions and had shared this knowledge. But in his vision, his initial vision, he had it all laid down. He didn't publish it. Of course, he was 16 years old and he moved on. And then in 1975, he went to Alaska to work in Alaska and doing some metallurgic stuff. And he visited a meeting, and there he heard the famous quote that has become a popular quote on the internet, even though people don't even know the origins. You can look in my channel. I have some in the community part, you can see the my research around this. The quote by Thomas Jefferson, that famous quote saying, "If American people ever allow banks to control the issuance of money through inflation and deflation, they will eventually become the owners of all land, all businesses and everything, and then the American people who conquered this land will be their slaves." Something along these lines, of course. But then that sparked in him, well, he thought that Thomas Jefferson had already understood it. Then he started again to do some research on the sayings and the letters of Thomas Jefferson, and he could not find in the works of Thomas Jefferson, George Washington, Benjamin Franklin, any evidence that they got it, and that they could have established a just monetary system from the get-go in the foundation of the United States. So they were not there. They could not see it. They were already observing anomalies in regards to interest and against the currency imposed by the crown. They were against it. They wanted their own currency, and they were investigating what would be the best form of currency or the best system for this new enterprise, the United States. But they did not put in the Constitution then the prescription for what would be the just monetary system. So then in 1979, Mike Montaigne got himself writing. He says that he had some sort of call that he needed to write it. It's a quite dense book called Morphallaxis. I managed to find it selling online. I think it was the last piece that one could find on the internet. Right now you probably cannot find a copy of it. He published around, from what I remember, 2,000 copies or something along these lines, and he self-published it and distributed it. He sent it to universities, churches, and so on, but never got any feedback from anyone. Anyway, there we can see even this quote by Thomas Jefferson, right? This spoof quote. Thomas Jefferson didn't say that, by the way. Not in those terms, at least. But then, the concept of mathematically perfected economy revolves around the issuance of money in relation to the value of property, and that it should always be at par on a one-to-one ratio with that value of property, because then, and only then, we would have no inflation, more money, or deflation, less money in circulation in relation to the value or the remaining value of the represented property. So money comes into circulation to represent property, new money to represent property through promises to pay. And then it should leave circulation as the value of property goes down. The example that he gives is the $100,000 to say a unit of value. So $100,000 home with 100 years lifespan. This is important because if the value of property goes down, it is because it has a lifespan. So through its lifespan and through consumption or deterioration, the value of the property will go down. Without maintenance, a house becomes dirt, right? Dust. So by giving this estimation of 100 years for a house, for example, a specific house, 100 years lifespan, estimated. 100,000 is issued into circulation. Then 100,000 needs to, at the end of 100 years, the money in circulation in relation to that property should be zero, because the value of that property it depreciated. That property depreciated through years until the year 100 down to zero. So there should be no money representing any value of property, because there is no property or value of property anymore to be represented. How would that occur? So how could one be, how could the amount of money in circulation be always free from inflation or deflation, or be neither inflationary, the volume of money in circulation, how could it be neither inflationary or deflationary? Only if through the promise to pay there would be this schedule of payment, let's say monthly payments, to retire from circulation. That money would be destroyed, the money paid destroyed, as the value of money depreciates. So just to be for didactics purpose, we use a linear rate of depreciation, right? So let's assume that it will depreciate $1,000 per year through 100 years. Then $1,000 only should be paid and retired from circulation by the proprietor or the possessor of that house or that property, the promisor, for example. So the promisor pays $1,000 per year, and that $1,000 paid is eliminated from the system. It must be destroyed, because there is no, it doesn't, that amount, the 1,000, is no longer matching value of property, because it already went down by 1,000. Well, then we would have always an equivalence of money in circulation in relation to the value of property. For a $100,000 home, then, if we set a monthly schedule of payment a retirement of money, it would be $83.33 per month. Who cannot pay that? To become the owner of a house. Of course, you are already thinking, well, but nobody lives 100 years, then what's gonna happen, right? This is the property will still retain value. So if a person dies at year 30 and already 30 years of this schedule of payment is already fulfilled, there is 70 years remaining for that property. The one who will take possession of that property will just be responsible then for retiring the remaining 70,000. Of course, the proposition of my mathematically perfected economy is not to be a linear rate of depreciation, of course. It should be adapted, perhaps, to the type of product, but it should be non-linear. It should start with a higher payment. For example, someone who will take possession of a new home is then consuming the property in its initial stages at its finest state of value. Therefore, the person should be paying more at the beginning. And then the non-linear rate of payment would make then a parabolic curve. It would make a curve. So at year 30 then, if we can draw it, so it would make like this, boom. At year 30, or at year 100 here, this is year 1, this is year 100. So at year 1, the person is paying more, and as time goes by, the payments go down in the amount to be paid and retired. And then at year 30, let's say it's around here, the new person, because that prior owner died, the new possessor of that property then will start paying from here. So it's a much less, it's a much lower payment than even the 1,000 per year that we were speaking. So, and then by this curve, then if you can do some calculations, it should be about, let's say, 50%. So 83 by 2, let's put it at 41 per month, going down until 0, remaining 70 years. No usury. This is mathematically perfected economy. Who doesn't want to live in such a world? And rectify the creation of money. Rectify the issuance of money so that we all could prosper and thrive as humanity and not live under a perpetual sanction, monetary sanction, imposed by a few, an unhappy few, because these people are not happy. They live in fear, of course, and they know that all the people around them they're just rats, and that they cannot really sleep well because they feed on poverty, they feed on slavery, because we all, whether we have loans to be paid or not, we're all slaves to this few. So let's talk about inflation again, but in the other aspect. So there is another type of inflation called price inflation, right? Because you look at the supermarket and then you think, well, prices increase, so that is inflation. Well, we have two types of inflation: circulatory inflation and price inflation. They're two distinct things. What the so-called economists, who have their Nobel Prizes and so on, what they say is that whenever money is issued, prices increase automatically, magically. Because there is too much money in circulation, we have too much money. So we are competing with each other to pay more. And then the business owners, they're always looking after how they can exploit us more and get more from us because we are willing to pay. And we had too much money to pay on a piece of cheese. That's what they claim, right? And that these business owners are becoming ever more wealthy because they are able to charge more, and because we have more money. Because we suffer from too much money. We look at our wallets and our bank accounts and we have so much money that we cannot, we cannot wait until we are just throwing around and, pushing the other guy who wants to pay something, and we say, hey, I want to pay more. That's what they say, that we suffer from too much money. We have too much money in circulation. And they want to restrict it by what? By doing what? By raising interest rates. That's the remedy for price inflation, is to raise the interest rates. And you buy that, and you read it in the newspaper, and you believe in that. Wait a minute. Are you trying to tell me that if we make the cost of production higher by imposing a higher interest rate, the product and the price, the final price of the product, will be lower for the consumers? Again, let me go back. So let's say a business owner needs a so-called loan to buy machinery to produce a specific thing and to sell it. And then he needs a loan, so-called. Let's go back to 100,000. Now is this sum, or million. Let's put a million. So he needs 1 million units of currency to buy this machinery in order to produce so many products to sell to the public. So then, what the economists say is that if this business owner will pay more in interest, having more cost, that the price of the product, the final product, will be lower for the consumer. Are you believing that BS? Really? How? Any cost imposed upon, or extra cost imposed upon the production line will be passed further, or it will be embedded in the final price. The price will be higher if the cost is higher. If the cost is higher by imposing a higher interest rate, the price of the product will be higher. Well, you see, there are so many lies and obfuscation in this insane world, and that people just go and move with their lives. Oh, I don't want to hear, I don't want to know, because, oh, I have my bills to pay and I have my debts to pay. Go listen to Mike Montaigne. Go fathom. Listen to the guy. I mean, who am I? I cannot teach or explain. I'm not a mathematician. I'm just someone who had the opportunity to learn from him, from Mike Montaigne, directly. And through many years, I tried to promote his work. But there's so much noise around, so many distractions, that it became just something that seemed impossible to accomplish. To make people understand simple concepts and reality. So, Mike says, if I'm not mistaken, immediately after the implementation of mathematically perfected economy, which could occur in days, we would be automatically at least 12 times in a more with more money to sustain ourselves and our economy and to make it thrive again, or for the first time as we have never seen, as it should be. Everybody being able to acquire their houses, and we would see construction, the business of construction, like thriving like never. Full employment, no poverty, everybody owning their houses. Even you would be able to afford a house for the homeless, for yourself and for a homeless guy. And you want to pretend that you are charitable, and that you are a communist, whatever. Wake up! Wake the fuck up! Sorry. The love of money is the root of all evil. In the Bible, Jesus Christ, the story of Jesus Christ expelling the money changers, the bankers of that time, from the temple, is quite an impressive image of the one who was understood to be the Prince of Peace, becoming so irritated with what he was observing that he engaged in violence, in a violent act to expel, by whipping, the money changers out of the temple. Because of their atrocities, because of what they were doing through usury and all the nastiness and wickedness that they were imposing through the people. If you turn around and you look the other way and you pretend that, oh, it's all fine, I have my job, I have this, I have that. Look around. For how long? Look at the world. We could stop so much BS that's going on, like wars. We could, if we took control again, or for the first time, of the printing house, and we stopped the madness, and we could live decent and prosperous lives. We could fix the issues. We could invest in together with the collective promissory obligations, we could fix everything. Well, it's approaching 1 hour. It's already more than 1 hour video, so we'll continue in the next video. If you like this video and you want to hear more, do what you know you should be doing on YouTube. I mean, sorry for being a little bit irritated by now, but yeah, it's so many years that I'm just observing BS, more BS, more BS. Imagine Mike Montaigne since 1968, seeing what's going on. And people just carry on slaving. Well, let's see how this series will continue. But yeah, there are times that we need just to let things out. Alright, thank you. If you dislike this video, I don't care. Bye.